You're listening to Politics Unspun with me, Jack McCluskey.
And me, Charlie Carter.
We're two economists discussing the hottest political debates.
Like, do tax cuts really boost economic growth?
How high should the minimum wage be?
Is Scotland ready for independence?
Should post-work pints be free?
Yes. And because there's nothing we love more than the sound of our own voices, we're putting our future career prospects on the line to share our thoughts on each one of these deliciously controversial topics.
We hope you enjoy.
Hello, Jack.
Hello, Charlie.
How you doing, mate? You alright?
I'm doing really well, Charlie. It's been a really good week for me. What about you?
It's not been a great week, I'm not going to lie to you, Jack.
Anyway, what are we talking about today, Charlie?
So we're talking about capital gains tax today, Jack. It hasn't been my favourite topic to research. I'm not going to lie to you. I realised in every other podcast I've probably used the word, this is really interesting, about 50,000 times. This one is not really, really interesting to me, personally.
Oh,
but
that hurts my feelings. Why don't you like it, Charlie?
It's just tax, innit? You know, it's interesting to a degree, but once you get down to it, it becomes very political, very polarizing to a degree. And I think rational argument sort of goes out the window, which you could argue is what we specialize in. But you can get bogged down a lot in the technicalities of capital gains. I mean, it is still interesting. I'm just putting it in the context of the other episodes that we've done, which I think are slightly better. But it's been a massive part of the political discourse over the last year, and it's been a massive part of the election campaign as well. And obviously, there's now a debate over whether Labour should increase the level of capital gains tax. So here are the policy boys, you know, ready to educate the masses.
But also try and spur some life into this topic, right? It does sound uninteresting, but we can make it work, can't we?
Absolutely. Yeah, that's what we're here for. You know. So what is capital gains tax, Jack?
So, Charlie, capital gains tax is a tax on sort of the profits you earn from selling some sort of asset that's gone up in value. And the capital gains tax depends on the asset type and your income level. I'm going to try and explain how it works better than the government website, which generally had me scratching my head a little bit, even though it is actually just a marginal tax rate. You pointed that out to me, Charlie. It is basically just there's a lower rate, which is 10%, again, on the profit you receive. So difference between the sale price and how much you bought it for, and then a higher rate of 20%. And I'm not going to go into how you calculate that really.
That's the reason I got so bored about this, is I think when I was doing the research, just going into the technicalities of it. So I think we'll spare everyone the details.
Yeah, we will. I think the only point that we've really got to make is that there's two rates. There's a 10% rate and a 20% rate for when it pushes past the basic tax band, and that you do get £20,000 worth of tax-free savings as per year as part of your ISA. So that's what makes it sort of extra progressive in the way that most people won't be saving more than 20k a year, I would say. I mean, we're definitely not, are we, Charlie? So
speak for yourself,
So
Jack.
Most people won't be paying tax. Right?
Absolutely not. Go back to the minimum wage episode description and you'll know we're definitely not sorting that sort of income away.
Exactly. So you can see that this tax is normally levied on sort of more well-off people. So, Charlie,
Absolutely.
why do we need capital gains tax?
Yeah, no, absolutely. So obviously, capital gains tax is a way of obviously raising revenue for the government. I think currently it raises about 15 billion a year, which can be used to pay for public services, healthcare, education, infrastructure, our PhD stipends, which is obviously massively important and contributes to the world immensely. Capital gains tax, obviously, largely, as you very beautifully pointed out, benefit wealthier individuals as they're going to hold more investments like stocks, real estate, etc. And essentially, just by taxing those individuals, like any sort of progressive tax, the idea is to bridge the gap in inequality between the richest and poorest in society. There's also a third mechanism which is really useful for capital gains, is that higher capital gains tax might reduce short-term speculative trading, which can lead to a more unstable financial system. As we saw in 2008, speculative trading, especially complex assets, can cause some real problems in the economy. And having a tax that essentially stops or puts a friction into the economy that stops short-term trading and short-term buying of assets only to sell a few days or even hours or minutes later is a way of sort of introducing some structure into the financial system and keeps us all a little bit happy for a little bit longer, you know.
And I see another part of it is that some people, just from a moral standpoint, are a little bit upset that the tax rates are lower than if you'd been earning that money through income.
Yeah. Right. So this is where you sort of get to the crux of this issue, and I think it is quite a complex issue, isn't it? Because capital gains tax is, what did you say it was again? It's 10% or
10% at the lower rate, and then 20% if you're
Yeah, and I mean, if you're comparing that to the income tax rate, there's a little bit of a moral problem there, that essentially people who are very, very wealthy can just use this as a very easy tax dodging loop, not even a loophole, is right there in the system, just to be able to, you just, instead of earning an income, you just sell stock or earn a dividend, and that's taxed significantly less.
Yeah. I think it really annoys people that you can just sit on an amount of wealth and then end up paying less tax on your earnings, living off that and not paying as much tax. But there is that other side, which you just said there about the tax loophole part. And it's the idea that you tax realized gains. Realized gains is once you've actually sold the asset. But actually that asset might have been going up in value. You just haven't sold it. And what these rich people do to avoid some tax or pay less is that they will use their assets, which has grown a lot. We're talking about Elon Musk, who has Tesla shares, which are worth a lot of money. He doesn't technically have that money. They're just stored in assets that have boomed. And he's, the world's richest man, well, whenever he was. And the point is, you can use that capital as collateral on a loan and then receive a loan, which is they use as like income and not have to pay any tax on that at all. So the idea is, if we're not taxing unrealized gains, if we're only taxing capital gains once they're realized, then people are able to not pay tax right until they're much older, because they're never selling these assets.
Absolutely. And that sort of gives rise to this debate as to whether we can even tax unrealized gains. And I think a lot of economic experts just say the practicalities of taxing unrealized gains are just too difficult to be able to enforce. And so there is this sort of unfairness baked into the system, whereby people who are earning what we called earned incomes, who are going to work, doing a real job producing something, are being taxed less than people who are essentially just allowing assets in the form of housing or stocks and shares or whatever to accumulate. And that sort of gives rise to, why does this unfairness exist? And I think it always goes back to our old friend, savings and investment, right?
We can't get away from it.
We've
talked
everywhere.
about this topic basically every episode.
I know. Well, I think, yeah. But why can't we have a level of capital gains that's equal to income?
Yeah. I guess the problem is that we see it in the economic models we used to do, that they'd always say, well, income tax, that might not affect the real economy in terms of growth and things like that. But capital taxes were always seen. We never had a model that specifically looked at capital. Yeah, but everyone always said, like, don't even touch it. Like, can't do that. And the idea basically becomes that it discourages savings and investment if you tax the things. And these are things that have you could almost say external effects to people in the way that it boosts their wages by increasing people's productivity if you invest in these assets.
Especially it's because it's the wealthy people that are saving and investing. By imposing a tax that in any way affects their savings behavior, because the free market is always optimal in the absence of any frictions, if you introduce a tax that distorts any saving behavior, you're naturally it's going to be inoptimal. And the IFS said this when we were reading about this topic, and you have to have a very, very strong justification for changing capital gains tax, because if you don't, you're just going to affect savings and investment negatively without any corresponding positive effects.
Exactly, and that's the fear, I think. And what we've been seeing is that the one positive effect you want to see is that you raise some amount of revenue from it. And from what we've been reading, it doesn't seem like there's a massive amount of money earned from increasing this tax.
Well, there seems to be an incredibly small amount of literature and research on this topic. I don't know if we've just
weird, isn't it?
I don't know if we've just missed it, which could be possible. But it just seems like there's a very small, from big institutions, you'd imagine there'd be more on this. I mean, the IFS was in part founded because of its strong opinions on capital gains tax. I'm not seeing much at the moment about it. But from the figures we have, it's not looking positive for tax revenue.
No, it's not. So we just looked at the HMRC Ready Reckoner, and look. We don't completely trust their methodology.
I don't trust the HMRC at all.
Well, they've been stealing money from you for ages.
I think they still. Well, they owe me £500, but that's another topic.
But the point being that we don't know really what their methodology is and things, but we've hypothesized that it could be just a random number.
When we saw their methodology section in their document, they said, and we quote, "We use standard HMRC models." And we go, oh, thank God.
It's nice to have transparency. It's the important thing, isn't it? But the point being that, look, take it with a pinch of salt, but their estimates show that, if you increase corporation tax, you could get a fair amount of money there. But if you increase capital gains tax, they were like, no, this probably will actually reduce your revenue, especially if you're taxing the higher rate rather than the lower rate.
And that's just because people presumably are going to be incentivized to move their capital out of the UK. And you've also got some sort of short run effects where people are more likely to hold their capital for longer, correct? That's what we were saying before.
Yeah, so like you said, it's basically capital gains is a tax on transactions, right? So it discourages you from selling assets right now because of present value of money. It would be better to hold on to the asset when the tax you'd have to pay is worth less. So it would have a slight discouraging effect on selling assets in the short term, which should mean that in the short term, you're not going to raise much money from it. But also it's this idea that if you're targeting the higher rate, you're targeting people, wealthier individuals. And I would say that their capital is very mobile, as in their assets. They can move that across border. It's much easier moving money across borders than it is like your permanent residence and things like that. So that sort of thing, I imagine it would move.
Which is why this sort of difference,
America.
this is why it differs from our discussion of non-dom to a degree, because that was based on permanent residency, where we're thinking more here about capital, international capital, which is much more mobile. I mean, it just takes going on a different website nowadays to a degree. So it's pretty easy to move capital abroad nowadays. Yeah, so that sort of adds to the reason, if we're not seeing any improvements in government revenue, which could be invested into development of human capital or helping, healthcare or infrastructure or whatever, and we'll also have a tax whereby we're reducing the dynamism of the economy by essentially adding a weight to savings and investment, which could then correlate to economic growth. It sort of seems like there's not a huge amount of positives to raising capital gains.
It doesn't seem that way. I mean, the IFS said it themselves that actually changing the rates is going to be maybe your least effective avenue. I mean, it's the one we always think of, like you want to raise more tax, increase the rate, fair enough. But they actually put more weight on changing which assets are taxed and also the tax base itself, right?
Yeah, so changing not only the assets as taxed, but also the people who are being taxed. So essentially this is just try and make people who earn a little bit more pay a higher rate of tax. Is that it?
You know what? I really couldn't tell.
No, I couldn't
They said
either.
tax base in quite a loose way. I couldn't tell if they meant tax richer people, more like specifically like top 1%. You could probably tax them. Like we've said, although their capital's very mobile, they're probably, the amount they save is probably quite inelastic. It stays quite stable. So maybe they're talking about that. What I got from it was it's the tax base in terms of like business assets currently get a lot of, I don't know, is it tax credits and things? They get a reduced rate, I believe. And they were saying there doesn't seem to be an economic reason for that particularly. You could raise that in terms of the normal rate that people pay. I also, on a personal opinion, the IFS didn't say this, I don't want to pretend like they did, but I don't see a reason why you couldn't increase capital gains on non-productive assets.
Can I just say, you said that as if we are like the spokespeople for the IFS, and I just want to say that we are actually. We've been contacted.
I'm sorry, the fact that they seem to release on your LinkedIn especially that something pops up after we've done a podcast. They say, "Oh, we're going to talk about this subject."
They do.
Now. They're clearly bugging our rooms.
My LinkedIn, every time this is no joke, Jack. Every time we say, "Oh, we're going to talk about minimum wage next week," "Oh, talk about pensions," every time something pops up on my LinkedIn and goes, "Oh, here is a meta study for pensions or the minimum wage or this," and I'm like, "Oh, thank God." And this one, they've outdone themselves this time because they didn't just give me a meta study. They actually said they're organizing an event on capital gains tax just for us. They actually said that.
Was it in red and caps?
Yeah, exactly. This is for Charlie and Jack. Exactly. No, but back to the idea of unproductive assets. So what are you saying with that? That you're...
Oh, just that the standard theory, like when we see it in the models, you shouldn't tax capital ever, is the idea that you want to accumulate capital to increase your productivity, your workforce, and increase wages, blah, blah, blah. Yeah. But, I mean, that doesn't apply to artwork, does it? You're not not increasing wages.
Well, we mentioned this in the pensions episode, I think, where we were talking about it depends on what savings are being translated into. If savings are being translated into machinery and forklifts and buildings and things like that, then it's productive. Or if it's intellectual capital, it's productive. But if you're just thinking about moving it into artwork, then that's just inflationary necessarily, isn't it? So.
Yeah. So unless we're talking about this, I don't know, going back to the Lorenz curve argument that at some point you tax too high and your revenues go down because, I don't know, capital's moving abroad, blah, blah, blah. Unless we're talking about that, if we're only talking about, imagine a closed economy where you don't have money moving outside the system to other countries, then I don't see much of an economic argument why you wouldn't want to tax gains on artwork at the same rate as income, or maybe even more than that, because I don't really see what the benefit would be.
Yeah, and absolutely. I think part of the 2007 reforms were that you would have a flat rate of capital gains tax, but you would be given forgiveness on capital gains if you invested into particular types of machinery. So I think it was up to 50,000 if you'd invested in, I think, what was it, plants or machinery, you got tax release on that. And so there are ways of mediating this destructive effect that capital gains can have on savings and investment, but it points to the fact that policy has to be very well designed to be able to mitigate that effect. But capital gains should definitely take into account productive versus unproductive capital. There's also this idea
on that. Sorry,
no.
Can I, just before we move on that topic? Do you think it could affect? This has just come to me now. The housing market, maybe. So currently, there's capital gains taxed at a slightly higher rate for residential property that's not your main property. I was wondering, you could bump that up quite high, right, and stop people from using property as an investment asset.
Well, I mean, I'm vehemently against using property as an investment asset, and I think there should be much more political discussion on that, because I think we're both in somewhat of an agreement that it's not just a supply side issue, it also is a demand side issue. I think it was, because we haven't prepared for it, but I think it is a very high percentage of homes that are currently unused because they're just there as investment vehicles and renters depreciate the value. So essentially wealthy people just holding them as investment assets. And I think there needs to be more done in this area massively. And one of the mechanisms for relieving this pressure could be to increase the capital gains on these houses, right? I think Japan has a tax, 100% tax on housing. If you're a foreigner and you buy a house in the UK, in Japan, then you actually have to pay 100% tax on it. And I'm not saying it should be differentiated for people who are not from the UK or versus the UK. I'm just saying that I think there should be much higher rates of tax on second homes. And that would be part of capital gains.
Yeah. No, I think it would be interesting, because I know that the IFS are really against stamp duty.
Paul Johnson wrote a book on it.
Really hate that.
I mean, who's bought that book?
If you look up, I know. It comes up multiple times. Like it's the one thing they really, really stand for now is get rid of stamp tax.
We should do an episode on stamp duty then.
But if we disagreed, I think we'd get letters to our house.
They'd send the hit squad out.
Exactly. Yeah. Sorry, I did cut you off earlier, Charlie. So
I've completely forgotten where I was going.
Oh, I'm so sorry, man. That is my fault.
So there was a suggestion of ending the forgiveness of capital gains at death. So currently, if you have the audacity to die under the UK government's watch, then you get forgiven of all your capital gains tax. And essentially that is just to ensure that you're not taxed twice on inheritance and on capital gains, I presume. So, I mean, I have a relatively strong opinion on the fact that this should be taxed at death. I think there's no reason to not remove the forgiveness clause at death. But the problem is it doesn't really raise much money. And the political outcry for ending it would probably be quite high. So whether it's worth the economic / moral / political trade-off, that's the main question of this.
Yeah, again, it was just over $1 billion, right? Something like that.
And I think it's just over $1 billion, yeah.
Yeah, and varying estimates. I think capital gains in total raises, I've got it down as 17.8. You had it at 15
I have 15,
billion.
but then mine was from an older source, so yours is probably more accurate.
Right, yeah. But that's still, it's like 1% of GDP, and adding 1 billion capital gains tax being talked about because we're trying to fill this black hole that Rachel Reeves keeps talking about, which is 20 odd billion. And they've tied their hands behind their back saying they won't raise VAT, national insurance or income tax. And some people have turned to capital gains saying, oh, you could increase this. But what we're seeing is, look, if you're increasing it by $1 billion, it's not huge, is it?
Well, it barely covers the cost of driving into London nowadays. So,
yeah.
No, and I think the political discourse, I mean, it's in the movie Vice, isn't it? It's the death tax. You know, if you call an inheritance or capital gains forgiveness, if you call that a death tax, then the political outcry will be pretty huge. And whether it's worth spending your political capital on something so small economically, I just don't know. Yeah. So another thing the IFS is very adamant on, we are really just becoming the IFS spokesman, aren't we? We really are. But if anyone else in the country did their job properly, we'd quote them. You know, if we wouldn't have to end up quoting the IFS all the time. So one of the main things the IFS really petitions for is this idea of reintroduction of inflation indexing. So would you mind explaining a little bit what that is, Jack? Because I'm not sure I fully can explain it that well.
It's just the idea that if you've got high rates of inflation, you can imagine that the rates of return you receive on sort of capital and investments, inflation is sort of bedded into that. Now, if the tax system looks at nominal rates of return, not real rates of return, which would be the rate of return minus the inflation part, then you've got this weird distortion that when you've got a high inflation environment, you're taxing relatively more on a real basis than you would if you're in a low inflation environment, which would be like recessions and things like that.
Yeah, see, I mean, I'm not 100% sure about this. Maybe I just don't understand it. That could, again, be possibly the case. But how do you distinguish between different types of assets in this system? Because under some assets will thrive in high interest rate environments. Normally fixed rate interest or fixed rate bonds or whatever will do pretty well. But you could argue that maybe not over the last couple of years, but predominantly if you have a high interest rate environment, stocks and shares and equities tend to do as well. So I think it would be difficult to sort of differentiate between, because you're basically trying to say how much of this increase in value is actually real and how much of it is just a manipulation of inflation. And I think it's really difficult to fairly judge how much of an asset increase is down to inflation. And I think that's going to be tough. Do you think? Or am I misinterpreting it?
No, I think it is tough. I mean, I guess they would just take a broad thing of just using CPI inflation. They wouldn't break it down to certain assets.
But then that's where I feel like a little bit of the distortion comes in, right? Because if you have an inflation indexing, does that put emphasis on people moving money into fixed rate assets as opposed to more variable, volatile assets like equities? And you're essentially distorting saving behavior in that way.
Yeah. Well, the idea is that this wouldn't be a distortion; it would be removing the distortion that already.
But what I'm saying is, you could introduce another distortion into it if you don't do it correctly. Again, I might just be. I don't have a very strong opinion on this. I just.
I think. Yeah. I mean, I'm broadly okay with it. The idea that you would take off the rate of inflation from just general rates of return. I think that would probably be an improvement. Do I know enough about it to make a strong opinion on that? Probably not. My one observation is that we don't talk about that really when we're talking about income tax thresholds. I don't get why you would allow this sort of allowance for just capital gains. If we're going to do it for capital gains, I mean, I would do it for income tax thresholds as well, which you've got this thing that we talk about called fiscal drag, right? Which is where if there's inflation, then more people get dragged into the higher tax bracket, and then you just naturally get an increase in tax revenue from that.
Yeah, I mean, let me just think out an idea a little bit, talk out an idea, sorry. So if you have a system where people are benefiting from inflation in terms of their savings, then people are more inclined to save during an inflationary period, right? Because inflation indexing essentially brings down the return to assets during an inflationary period.
It would bring down the tax. Yeah. So compared to the current scenario, you would be more inclined to invest in an inflationary environment than currently. So you would be more inclined to save. Indexing.
Which you could argue could have a positive auto-correcting effect, which essentially people save more during inflationary periods if you don't have inflation indexing.
Oh, that's beautiful. That's very nice. Because normally what the monetary policy is trying to do is that when we've got inflation, we increase interest rates so that we encourage saving and stop spending and blah, blah, blah. And the idea that would reduce demand and then inflation will be brought down. What you're saying there is that by having this inflation indexing, that would reinforce that effect just sort of naturally. It would be a natural...
If you don't have inflation indexing.
No, you're right. Yeah, no. If you do have inflation indexing, you remove the natural...
Yeah.
Oh, that's so interesting.
So I also think that... I know the IFS is very keen on this, so I am, as we say in the intro, putting my future career on the line. But
treading lightly, yeah.
There is that, I think, that is not insignificant. I also think, I mean, they mentioned, like you just said as well, like if you're going to do it with one, you have to do it with everything. And I think that adds quite a lot of complexity into the tax system, which is never particularly desirable. Do you think?
Well, I don't know. If you just linked it to CPI, maybe that's just easy enough. I don't know.
Yeah, maybe we do. Yeah,
that would make sense to me.
Okay.
It's just I don't know why you would talk about it just with capital gains and not talk about it with just your income tax thresholds.
Yeah, possibly.
But I think what we've seen there is that it's actually quite an interesting idea. Maybe we should have fleshed out our ideas on it more.
Well, we can't. We can't be. There's genuinely not a huge amount out there on this. We did put. I think there was only so much you can really do on this, but it is a complex because it's a tax that's explicitly dealing with savings decisions, you want to take a lot of care. I think there was one, I don't think it was the IFS, I think it was someone else, but I've forgotten who that someone else was. But I saw something that said the best way to do policy is essentially to keep it stable. And the best way to keep policy stable is to do it right in the first place. You don't have to keep constantly reforming it.
Yeah.
That's what we're sort of running into here, that you want to take your time with this policy because it can cause some real problems.
That's true. Especially if we're talking about investment from abroad, they always want sort of a stable idea of what either corporation tax or in this case capital gains tax is going to be going forward. So.
Which we obviously haven't had any stability really in economic policy for a while. Every policy or report I look at is just going, oh, well, this was the policy 3 years ago, but there isn't really a policy on it now. I see it a lot when I'm researching topics in my PhD. It's quite bizarre.
Yeah.
So
I wonder if these think tanks are going to go out of business because there's going to be just less. There's not going to be a new policy every minute with the new government, hopefully.
Well, I hope not, Jack. We need some form of employment after we work out what we're doing with our lives. So I hope
Sorry, Charlie. Continue. I've introduced.
No. I hope the government is still as incompetent as they were when we live, so we have jobs. I went to Norway recently, and my family said, "Oh, I loved Norway," and my family said, "Oh, are there any economic jobs in Norway?" I was like, "Oh, they know what they're doing." So, I need to be in a country that's consistently falling apart. So, what would you say your main takeaways from this topic are? What would you do with capital gains tax with this information? How would you reform the system, do you think?
Yes. Okay. So I would remove the capital gains forgiveness at death.
Sorry, I thought you were just going to say, I'm going to get rid of capital gains entirely. I was like,
no, just the forgiveness at death. I genuinely just don't agree with that. I don't understand why it's there. And I don't buy into forget it. It's just rubbish. Move on. I would increase the general capital gains tax, maybe the lower rate slightly more, but only to the extent that you actually believe that you're going to get tax revenues from it. There's no point to the extent where you don't get tax revenues anymore. That's silly. I think indexing for inflation was on my list. You've made me uncertain now with this idea that it could be sort of a self-modulating monetary policy almost, which is quite nice. I would remove some of the business asset disposal relief that's out there so that business assets are taxed at a similar rate to other capital gains. Although I wouldn't do that in cases where it leads to double taxation through, corporation tax and things like that. So I'd be wary about that. I would increase the non-productive asset capital gains tax to income tax levels. So again, we're talking about artwork and things like that. Obviously, I wouldn't do it for main personal homes, but I think for secondary homes, I genuinely am considering the idea of pushing it really, really quite high. I'm interested in thinking about that more. I reckon there's probably some problems with it, but you get the idea.
Well, that'll probably come up in our housing episode, won't it, a little bit, hopefully.
Yeah, exactly. So I can think about it some more. And then lastly, Charlie, before we hear yours, I'm, as always, whenever we talk about tax, pursue international agreements so that there's a minimum tax rate internationally, especially for the top 1%, where things are just normally more mobile, especially capital, so that the top 1% can't just move their investments to, the Cayman Islands, that they will have to pay a minimum capital gains tax. But again, not sure how much tax revenue that brings in. I am interested in the idea of the taxing unrealized gains for very rich individuals, so people that we could track or monitor their holdings, I imagine, because I see the one problem with taxing unrealized gains is that if we're taxing everyone's unrealized gains, the administrative cost of that's very high. But if we're just doing it for like the Elon Musks of the world, I think it's feasible and you would raise a lot of money from that, which would be better spent elsewhere. So those are my main ones. What about you, Charlie?
Well, can I just echo the right honourable gentleman's comments? Because I pretty much agree with all of them. I think that's the first time this has happened. I just want to add a couple of things on them, but I don't have any disagreements. So I agree with all the technical stuff entirely. In terms of changing the distribution of weight that's put on business versus non-business assets and the productive assets as well. I really understand the recognizing not double taxing. That's really important. And I obviously really agree with the housing capital gains tax. I think that should be increased on second homes massively. Keep first homes untouched. I think that's the right thing to do. And I also really agree with the international agreement thing. And that's becoming, I know it sounds aspirational and sort of idealistic, but there is a massive push, especially in academic economics, to push for more internationally recognized agreements. It's been a massive part of the famous Capital in the 21st Century book. And it's also been a massive part, obviously, of the corporation tax for multinationals under the Joe Biden administration. So I think that's really important. And on unrealized gains, I think this is something I want to talk about a little bit more consistently. Is one of the things I feel very strongly about, that we need stronger data on individual level wealth, because that's not going to only help us impose wealth taxes. It's going to help to cut down on administrative burden. It's also going to be really, really beneficial for economic research going forward. If we can have truly rich micro level data on individual level wealth and interact that with other policy decisions, we can make much more informed economic decisions. And I think going forward, a lot of priority, especially in the data science world, should be put on understanding individual level wealth, especially very high level individual wealth. So that's another thing. And that's going to really help with our understanding of capital gains tax, as well as anything else we want to talk about when we're considering policy decisions. Because at the moment, very high net wealth individuals are very underrepresented in survey data, just because of how few there are. So you can't get very good estimates on those people. So I think this is another, just like the wealth tax and other things, and pensions as well, it's going to be really, really useful to get good data on wealthy individuals.
Absolutely. No, that's a really good point. And spoken like a true data scientist.
Yeah.
Give me more data.
And I honestly can't get enough of it. Honestly, that's the one problem.
What does it your supervisors say? If it's below 50,000 sample size, they just won't go near it.
Well, I don't want to start throwing shots, but if you're throwing shade. No. I mean, data is. There's a really good book. I know you're not a fan, Jack. Capital in 21st Century. The book that critiques that book is a very good book.
Oh, right. Okay, got
and
you.
that puts a lot of emphasis on the fact that we just don't have the data available to be able to answer a lot of the questions that we need. And it's been highlighted in this episode, the complexities of capital gains are not matched with the complexity of data that we need to be able to fully understand it. So, yeah, I think that's a nice thing to end on, possibly.
It is, yeah. No, I think that's been... I think it's quite nice that we came to a consensus among us. Yeah, it seems like the less we know about the subject, the more we agree, which is...
Yeah, probably. Well, that's probably the problem.
Exactly, yeah. But as always, Charlie, it's been really nice talking to you.
Lovely to catch up.
See you next time, guys.
See you next time. In a bit.